Hello and welcome to 10 Minute Stock Pitch. Today we're going to be doing Tesla. This is kind of part of the introductory series. As I said with Apple, I didn't take this like crazy seriously or anything. So this is just for you to get an idea of how I think about businesses, how I come about these ratings. And I'm going to be doing this with companies that you probably know a little bit better. Okay, so let's go ahead and get started here. Sorry, I'm going to turn this down a little bit. So overview with Tesla here, I labeled it as interesting. Again, the ratings that I have are not interesting, interesting, and very interesting. So the reason it got interesting is because of the free cash flow plus growth numbers you can see here, obviously very nice, and then also I have total numbers, uh, kind of are not great, right? But because this is primarily a growth business, I don't want to say that these don't matter, but like business, the type of mode it has, how cheap it is, management's ability. A lot of these things don't matter so much if you're looking at uh, like a strictly growth company, right? So these types of things you have to be pretty lenient on when you're looking at a company that's in serious growth mode. It's opening a bunch of new lines of businesses. It's starting a lot of new things, and it's still pretty young in its industry. So this, Tesla is this kind of more growth focused company. So it's going to be a little bit more difficult to kind of focus on all of these factors too much, because what really matters at the end of the day is going to be growth for them and whether or not they can do that. And if they can't, it's not really worth looking at these other things here. So um, I need to figure out why this thing is. Okay, anyways. Sorry, I was trying to get this thing to work in a highlight, but it looks like it's kind of frozen, so um, we'll just have to keep moving on here. So as I mentioned in the last one, free cash flow yield, this is free cash flow per share divided by current price per share. So you can see, again, it's a growth company, so they're plowing most of their free cash flow back into the company. So the actual free cash flow per share you get as shareholder is not very much, especially as a function of the current price today. Their average is a little bit better than current. You can see average free cash flow yield divided by kind of average price. This is over the last 5 years here, is about 6%. That's a little bit more decent for an S&P 500 company. That may be closer to kind of average when you would get there. And then we also have growth here. So you can see last year's growth was 18%, and then 5-year growth on average was 196%. That's a little bit overstated because of they didn't really have that much earnings come 5 years ago. You can see operating profit here was nothing. So they grew 165 and then 600% off of like almost zero. But they did grow 100% off of say 6 billion here. Um, so there still is opportunities for this company to grow. I guess we could look at quarterly kind of growth here. The quarterly growth. Oh, that's not growth number. Sorry. Uh, Quarterly growth, a little bit all over the place. Minus 23, 20%, minus 44, up 112, minus 53, minus 46. Revenue growth seems like it's kind of stalled to single digits. So, that's one of the reasons that this got maybe a 6 on the business. If it was just a car company, it'd probably get closer to like a 4. But they do have other opportunities that they currently have and other things that they're working on the pipeline, which is why I give the business a 6. And it's not just a car company, right? They're a little bit more of a niche car company. the appeal to a certain type of clientele, with the electric vehicles. And then, they also have their own brand name, right, which kind of bumps this business figure up a little bit. This isn't just business in a shell. This is like, uh, you know, their business in a shell and then how they run it. Because obviously, you could have a really bad business and a really bad industry, but if it's run really well, you can still get a high number on this. Okay, so that's kind of what they got a 6. Um, as far as the moat is concerned, this is more about like, you know, um, economics between them and other business and how easy it is for a competitor to take business from them. That's essentially what the word moat stands for here. We're in the electric vehicle business, I could maybe even give this a little bit higher, but they still compete in cars in general, and cars in general, it's pretty difficult to say any car company has a moat. Um, Unfortunately, it's a high ticket item, but it still kind of acts like a little bit of a commodity business. So especially when interest rates are going to be really high, um, you know, new car sales just aren't going to do so well, which we can kind of see right now if you look at quarterly revenue growth numbers and quarterly earnings per share growth numbers. There's nothing super exciting there, um, because of the high interest rate environment we are. So it just depends on how that lasts. But it, if you can't constantly grow business in every environment, your average numbers over the holding period of 5 or 10 years aren't going to be that great. So companies like this are things that if you really do want to buy and make a lot of money off of these, it would be something where you know I would say trying to get a little bit of handle on interest rates could make you a little bit of money and allow you to kind of like trade this for better, right? So as interest rates are low or as they're getting lower, you can start to buy into this if it seems relatively cheap around that time. And then as interest rates are high, you can start to kind of like, take some profits on something like this. So just kind of an idea. Um, I just speak in general terms for things here. Obviously, you need to do your own research and really uh, dig into things and whatever. With this, I haven't talked to management at Tesla or anything. Um, and because it's a growth company, you almost always need to talk to management because you need to understand what they're looking at as far as margins on some of the new growth opportunities they're spending money on too. And also, you want to have an idea of kind of what direction they're taking the company, because these growth companies are spending a lot of money to grow on all these things. And you need to have a very good understanding of what they're growing into and what that's going to mean in the future. Just for an example here, I think, yeah, they're spending almost as much on research and development as they are on actual SG&A, meaning like employee salaries and everything. So that's just something to really kind of keep in mind. A lot of this stuff isn't horribly meaningful for a company that's really funneling tons of money into growth, especially if those growth opportunities are in different industries, have different gross margin profiles. They have the whole full self-driving software type of thing, which would really help out margins and make this look like a much, much different company. So cheapness, I have a 2 on cheapness. You can see EBITDA here is 55 times, price earnings 56 times. What this means, I mean, if you own this company outright with all the earnings, if they stayed flat, it'd take you 56 years to make your money back. That's not something I'm dying to buy anytime soon. So the growth really matters here, because at this level of earnings, obviously, this is a horrible thing to buy. EVA free cash flow is almost 400 times. I don't think they keep their free cash flow very high here. You can see cash flow from operations. Yeah, if you pull out any of this property, plant, and equipment, you're left with almost nothing. They're funneling almost all their free cash flow into growth for the company. So it's not really fair to look at their free cash flow numbers here so much. It just doesn't mean a lot. So, things you're really going to look at here is just kind of average growth figures, get an idea of what those could look like in the futures and what management is planning, spending all this R&D on and hoping for in the future, because the future of this company is going to matter a lot more than kind of what they've done in the past. Diluted share count. They're not really adding a lot of shares if you count in 2020, which I think you can give a lot of companies a pass on 2020. They added some share count. Growth company tends to run things with very little cash and very little room for error. So anytime there's kind of large downswings or issues in the economy, they're going to struggle. So you can see that's probably why they added a bunch of shares there. But they've maybe been adding an average of 2 or 3% shares a quarter, which a company that grew current earnings growth was 18%. You can forgive them for 3% share count there. But one of the things I did want to highlight that is going really well. So tangible book value has been growing a lot. Did we look at? I think they're 10 times book right now. Yeah, 10 times book at the moment. So it doesn't mean a ton, but that is one of the things that they are growing well. Even book value per share is growing. Free cash flow per share is somewhat growing. But again, these figures are things you normally look at a company, but because this is such a growth company, the growth is going to matter a lot more than what's going on today and how all the numbers really look into it. So that's kind of why this is somewhere between interesting and not interesting. Because it really takes a strong knowledge of what their future growth looks like. Your opinion on how prolonged high interest rates are going to affect business in the future. What their new product lines are looking like. I did pull up. This is just from the latest quarterly report here. It was interesting. Their energy generation and storage segment. You can see kind of as it's growing here, gross margins are growing with it. So this might be a business that has great economies of scale. So this could be something to look at in the future. If I remember correctly, their best gross margin was 25.6% here. As a company-wide whole. So this could be something that if it continues to grow and it continues to grow well, the gross margin may get better, and it may be kind of a better business than the car business, which is a large percentage of their actual revenue here. We're in costs here, so these aren't revenues. So don't focus on that too much, but yeah, gross margin is something to always kind of look at, and you can see volatility in gross margin and kind of decide whether or not they're in a stable business in general. This got a 6. As I said, it's not a great business, but they have their own little niche. They have a good brand. They have good customer loyalty. So that's why it's above maybe like a 4, which I would put most more kind of car oriented businesses in. And again, the future of this business depends a lot more than kind of looking backwards and what they have now. So that could definitely move if they ever get any of this full self-driving software up and going. So that's why I have it an interesting. There's still a case for it to be looking interesting in the future, but it takes more research, and I didn't do enough of that research. So anyways, as I kind of mentioned in the Apple video, I'm going to be going into a little bit less over what these things mean and talking a little bit more in depth about them. And then I'll also be talking a little bit more in depth about what the company does. I didn't mention that with Tesla and Apple too much because most people know these companies. So thank you very much for watching, and hopefully we'll keep these a little bit closer to 10 minutes in this one. So thank you.